Yo, what up everyone? In this video, I want to talk about how to grow a small account or even a large account and how to find consistency if you feel like you're struggling and could do so much more. Now, I've made a video like this in the past, but I still stress these points to this day. There's some good things in here that I'm going to show you the technical setups backing it. Keep an open mind, and if you are seriously struggling or just want to grow your account, try it out for a month. Let me know how it goes. It's what works best for me, and it's what I find to be the easiest. Now, before we get into it, if you want a very good resource, I'm going to link my Instagram in the description below, @InvestorTrade. I post daily trading recaps on here, along with very good trading tips and tricks that you're not going to find anywhere else. Be sure to follow it. You're definitely missing out if you're not. Link in the description below. But now let's get right into the video. So I stress this a lot. If you want to build your account consistently, I recommend trading and focusing on SPY and QQQ. SPY is the S&P 500 ETF and QQQ is the NASDAQ 100 ETF. You can trade any other related instrument. For me, I chart ES, but will trade SPY options, and I will chart NQ, the future, and trade QQQ options. From a chart standpoint, here is the S&P 500 and here is the NASDAQ /NQ. Now I'm going to get into why I chart them but still trade the options on SPY and QQQ in a bit. But they are the markets themselves. For me, it's less noise. If I solely focus on SPY and QQQ, I find it to be extremely easy to read its context. You can be laser focused on those names and you can learn their personalities pretty well. Now, that's not to say there's other setups and other names. I still trade other names: Apple, Amazon, Boeing, Facebook, Microsoft. I still trade them. I have experience. But for those that are looking to grow their account and find consistency, you can learn a lot about yourself and a lot about the market and the psychology and the context by solely focusing on those names. It's easiest to read the context and there's less emotions involved. You become less emotionally attached. If you're scanning for the next biggest setup and you want to be a hero trying to get something before it breaks out, you're emotionally going to be attached to that subconsciously. And subconsciously, that's going to affect your performance probably to the downside versus actually benefiting you. So there's less emotions involved in this because they're very liquid. There's no spread, they're very easy to trade, and they are very, very cheap. So going to the option chain, I have SPY contracts loaded up on here. As you could tell, at the money, going for about 90 cents to $1. One out of the money are going for about 60 cents, then 30 cents. So for every contract we buy, it's going to cost us 100 times that. So if we're buying it for 60 cents, one contract is going to cost us 60 bucks. If you were to look at the volume, I mean, that is crazy volume on SPY. 260,000 contracts we're trading today. Same thing on the put side, 140,000 contracts. And as we go down the list and further out of the money, they are still very liquid and they have a very high open interest. This is going to either be A, it's going to be easier to get in and out of these positions. B, it's going to be harder to manipulate. And C, we could easily get a large position without affecting the market due to the liquidity. And we aren't going to lose a lot on slippage. As you could tell, these spreads are extremely, extremely tight. I mean, a 1 cent spread or a 2 cent spread is nothing. You could easily market order in these and not get screwed on slippage, where other stocks, for example, let's just say Amazon, on a low volume day, you could be down $1 on slippage as soon as you hit the buy button. So there's not a lot of spread, very liquid, it's very easy to trade. They are also smaller size, and these names will yield a higher percent gain with less risk. Now I'm going to get into an example in a bit, but if I were to pull up SPY calls today, let's just say at demand. Now I'm going to link this chart up with this. Now these charts are identical, the top left and the bottom and the top right. If you were to buy SPY calls at demand for $1.43, by end of day they went up to about $4.20. So that $140 investment, which is the most you can lose, would have turned into 430 bucks for a 200% gainer. Obviously from low to high, no one's going to get that amount. The point I'm trying to make here is smaller size with these names yield higher percent gains and less risk because they are so cheap. And if we time the market correctly, we can get higher percent gains. Now also there's 3 expirations per week compared to 1 per week for other equities. If we were to look at Apple, for example, we would have an expiration for every Friday. These are 7 days until the next expiration. Whereas something like SPY or QQQ, every Monday, every Wednesday, and every Friday we will have an expiration. So if you know options and know how theta works and know how closer to expiration for scalping, how powerful that is, you could seriously take advantage if you time the market correctly. It's all about having a strategy as well, because in my opinion, ES and NQ, since they are the future contracts, which is why I chart them, they work very, very well with supply and demand price imbalances due to its highly liquid nature. They are the S&P itself is one of the most liquid markets in the world. So with supply and demand price imbalances, it works extremely well. We're going to get into this example, but if we were to buy puts at supply, these went down into demand where we bounced back into supply. That's obviously a perfect ideal world. It doesn't happen like that all the time, but it works extremely well. And when it doesn't work well, it's easy to avoid because you recognize certain conditions, when to be a spectator, when to sit on your hands. And there's pretty much a lot of setups. I don't want to say every day because some days you have to be a spectator if your edge isn't present. But pretty much there are setups, especially in the past week and a half. There were setups pretty much every single day. And if you capitalize on them, we're going to do a hypothesis in a bit. You could have grown a small account into a very large one in a short amount of time. And recently there's been a lot of volatility, which is a beauty to this. As scalpers, as day traders, trend traders, volatility is our best friend. So when there is volatility, there's large price swings. That's when we could think outside the box and trade different ways and really capitalize on large price movements. With option trading, you know how crazy the options could go up or go down when there is volatility and when there is large price swings. So last week, this volatility, actually the past 2 weeks, the volatility, in my opinion, brings very good trading setups as long as you could call an audible and be flexible and adapt to the current conditions. What I mean by this is the past 2 weeks, we're seeing a lot of different action than what we have been seeing, let's just say a month ago. So you need to recognize this as a trader, adapt and react accordingly, and you could take some very good trading setups. For example, NQ rejected supply up here 2 times. Beautiful setups those days to the put side last Thursday and Friday. Then sold off into this demand zone. We're below it now, where we caught a bid, and then the market started aggressively selling off. This also formed a new supply zone in this area over here. And every single day from the week of September 13th to September 17th, every single day we touched this supply zone and sold off from it. We also had demand a little lower in this area. Act like this is a green box right now. So we were contained in a very tight range of supply and demand on a longer time frame, where every time we came into the supply zone, it gave us a good setup to the downside. With the added benefit of volatility, myself and I know other members in the Discord strive completely in these conditions, and this is where we make the most amount of our money and where our account will grow tremendously. Obviously, there's going to be smaller imbalances inside. As long as you do not let your emotions get involved and make it less noisy, you could really simplify your trading and really wean out bad setups to good setups and journal, collect data, and know what works for you the best. Size up on it and grow your account. But I want to get into an example on the S&P 500, and we're also going to get into examples on NQ as well. To get more context of the first setup, let's go over the pre-market plan. I post these every single day in the Discord. We were watching the S&P. We had this 4462 demand zone that I'm watching if we could hold at the open if we pull back into it. If we get below it, we could sell off into the 4445 demand zone where we can play puts into that level. We'll get into that. And an upside plan was if we could get above 4475 and a break of a downtrend line because we don't have supply for about 20 points higher. So there's a lot of different setups, especially with trading the S&P 500 and trading NASDAQ. You can seriously get creative and find so many different entries and find an edge based off of your personality and your style. So the first actual trade that I saw off of this was once we bounced off of the 446275 from the pre-market plan. I mean, that was the low from the first 1 minute candle, and we got a 13-point rally into the supply zone. So if I were to pull up the option chain and go to SPY for the 17th, the 447 calls at that point on Thursday, let me minimize this, and I'm going to load up the 447 calls here. Let me remove this. And let's just look what these contracts did. So in the first minute, I have these two charts synced up. The low of the SPY 447 calls was about $1.17, and they went to a high of $1.94. So that is a 90 or 65% return in a 4-minute period. If you buy 10 contracts, I'm just going to call it conservatively. Let's say we buy 10 contracts at $1.35 right here, and we sell once it hits supply at $1.90. Our $1,300 investment, if we buy 10 contracts, is now worth $1,900, and we're making a $600 profit from a $1,300 investment. That's 40% in 3 minutes, strictly from demand into supply. Now, what I talk about getting creative is maybe you were looking to short the market. Let's just say maybe you missed this demand zone and you were looking to short the market in hopes of it to come down. Once you got selling confirmation at a supply zone, you always need confirmation no matter which way you play the market. Let's just say we wanted to play the 447 puts. Now, if we missed the call entry, go over here. Let me pull up the puts. Remove this. Now, once we hit supply, these puts had a low of $1.74, and they went to a high, a brief high about 20 minutes later for $4.47. So $1,700 investment is now $4,400. That's a 154% return in 20 or 30 minutes. And you could see there's not going to be a liquidity issue. Look at the volume down here on these contracts. I mean, that's very, very high volume. And that's something you want to see when you're trading because it's less, it's harder to manipulate if you are a large institutional trader, market makers, and it's easier to get in and out of your positions with either market orders, limit orders, because of the liquidity being so high. And we obviously had a sell-off. Now, let's just hypothetically, another example, say we missed the supply zone sell-off and we're trying to capitalize on this selling pressure, but we missed the entry at the high. From the pre-market plan, I was willing to play puts below this demand zone. I normally don't like playing puts below demand. It really depends on the context of the market. But because we had nothing supporting us below this low, and this low was made off of news, we really had a white space below this demand to trigger into the next one. So maybe instead of playing a break, you could have played once we retested this area and old support became new resistance. So let's just say we could have played puts at 959 right here. Stop maybe above this high. Going back to the option chain, just pull up the 445 puts. Go over here to my chart. You know, we could do this all day long. 959, the contracts were, let's just conservatively call it at 959. Conservatively, let's say we get in at 10 o'clock. Contracts were at $2. Nice liquidity. I mean, over 1,000 contracts traded on this 1 minute period on these puts. 5 minutes later, not even 4 minutes later, these went up 30%. So our $2,100 investment now is $2,600 in 4 minutes if we're buying 10 contracts. Right at this demand zone. And obviously we moved further into this demand zone where we could have capitalized. These contracts, absolutely exploded. And now let's just flip it again. Let's just say we wanted to play calls at this demand. I don't want this to get repetitive, but this had a beautiful bounce out of this 4445 demand zone. And look what happened. By end of day, we had a clean rally into the supply zone at 4475. So let's just say we wanted to play the, 445 calls at this demand zone. Pull these up here. Now instead of puts, we're playing calls at the demand zone. The low at that demand to the high at supply. The low was $1. So we buy 10 contracts. It's costing us $1,000. By end of day at supply, those contracts that were at $1 are now at $3.40 for a 210% gain in a few hours. Obviously no one's going to sell it or buy at the bottom. No one's going to sell at the high, so you got to be it conservatively. But even catching a portion of this move, let's just say the first touch of demand, let's just say, right? These were at $1.28, and 10 minutes later, 30% to $1.70. You're trading 50 contracts, 100 contracts, right? It's costing you $5,000, $10,000. You could easily make $3,000, $5,000, $7,000 on a quick trade as soon as you scale up your contracts. If you can become consistent growing a smaller account, 1 contract, 3 contracts, all you have to do is increase your size. And when you increase your trading size, your account is going to increase and your profits are going to increase as well, which is why I always stress to focus on the process. The rest is history. Profits are irrelevant because of how scalable trading is. Focus on consistency with small size first, and your account could grow exponentially once you control your emotions, understand these points, and just scale up your position sizes. Here's an example on NQ and QQQ. Now, like I said earlier, there are tons of setups. If you get creative with it, you could play the upside, you could play the downside, you could scalp. Some days you could trend trade. Some days you could get an all-day fader to the downside. Some days you could get an all-day runner to the upside. So just get creative. It's so liquid and there's tons of opportunities as long as you think outside of the box and use market context. So here's NQ, QQQ. I said we're in a very large balanced range where I'll be using supply at 15636 and importantly 15660, 74, and 97 as the upper extreme level. We must reject these zones and hold below where I will look to play puts. Obviously, we had a few other supply and demand zones on different occasions. For an example, I think there was a zone in this area over here. I also think there was a zone in this area. So you're not going to sell at the bottom, sell at the top and buy at the bottom. There's obviously going to be roadblocks intraday. I'm just illustrating how crazy these options are and the limitless amount of setups you could take. So let's just say we wanted to play puts on QQQ. These had a low of 74 cents. Let's just say we buy 1 contract. It cost us $74. That's the most we could lose. If we get a quick push down, now our contracts are at $1.30. Let's just say we get below VWAP, $1.30 conservatively. That's a 75% gain. And by end of day, these went up, 200%. Our $70 investment is now a $220 investment. And then the next day, which is even crazier because it was Friday, the day of expiration, if we look at the NQ chart, so that aggressive drop to the downside also formed a new area of supply. So we have actually extra confluence, more of like a big brick wall defending this area. We bounced off demand overnight, and on the way up, we also created demand, I think in this area as well. So obviously this chart is naked from the extremes, but if we were just to play puts at the supply zone, the low was 36 cents. And let's just say we got to the first demand zone at 10 o'clock. These contracts went up 167%. 1 contract at $36 is now $100. And then by the end of the day, these went up 1,197%. Obviously, no one's getting the low to the high. I just want to illustrate the power of the strategy, the power of same day or close to expirations. They absolutely explode if you time correctly. No one, I've never got an 1,197% return as an all day fader to the downside. No one's ever going to get that. If you're expecting that, it's pretty unrealistic. You have to get a portion of it. Your gains will slowly add up. A $500 account, you make a $200 profit on it. Now you got $700. You can now $700 turns into $1,100, then $1,900, and you just build up as long as you practice risk management. Your losses are smaller than your wins. You understand how supply demand works, and you trade your edge and your setups and do not let your emotions or noise get involved. You can make your losses minuscule. Risk to reward standpoint, it's in our favor, and I only take trades that are in our favor.